Over the past year, Intel Corporation, stock ticker INTC, has absolutely nosedived. We can see over the past year, they're down 46.67%. And year to date, they are down 45.05%. This is a stock currently trading at $29.24 per share. We can see at the beginning of this year, they were trading as high as $53 per share. So in this video, we're going to be jumping into my stock valuation spreadsheet to see if this is a company we should be buying or selling. And on this spreadsheet, we have 4 different valuation models. We have Graham's valuation, we have a discounted cash flow model, a multiples valuation, and a dividend discount model. And all 4 of these valuations will roll into our output tab. So let's go ahead and jump over to our stock screener. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. But the first thing we're going to do is we're just going to come up here and plug in the stock ticker for INTC and hit enter. And you can see this data is all going to automatically load in. Now again, we're looking at a 500-day chart, and you can see just how drastic the price decline has been. But let's go ahead and come over here and look at the dividend data. We can see they're currently paying out $1.46 per share, which gives them a dividend yield right at 5%. So a really good starting dividend yield of 5%, and with a payout ratio of just 30.4%, giving them plenty of room to grow their business and grow their dividends over time. Now obviously, all the moving averages, 20, 50, and 200-day, are down by a pretty large amount. If we come over here and look at analyst target price, we can see analysts currently have a target price of $38.43 per share. You can see that's been lowered over the past few months. If we come over here and look at the beta, we can see they have a beta of 0.65. So they technically shouldn't have a whole lot of volatility, but that has obviously not been the case over the past year. Well, let's go ahead and jump into our first valuation, and that is going to be Graham's valuation model. And this is a valuation model invented by Benjamin Graham, one of Warren Buffett's mentors, and here's the formula he laid out for us to calculate intrinsic value. Now, there's going to be a couple of different things we need to note here, but the first thing we need is our earnings per share for INTC, which we have automatically listed right here. We then multiply that by 7, which is the price to earnings of a company with no growth. And then we need to apply our growth rate projection, as we can see right here. Now, this has been revised over the past few months by analysts due to the outlook of the chip industry and just INTC overall. And they're currently expecting basically no growth for this company over the next few years. So that's definitely not a good sign. We then multiply that by 4.4, which is the average yield of AAA corporate bonds. And once we've done all of this, we divide by Y, which is the current yield of AAA corporate bonds. And this has really been going higher, which is not a good sign for this valuation model. It's sitting at 4.48 right now, as we can see right here, which gives this company an intrinsic value of $32.04 per share. So that actually is slightly higher than the current trading price. But keep in mind, the current yield on AAA corporate bonds was as low as 2.8 earlier this year. So if that were to be the case right now, we can see this intrinsic value would jump all the way back up to $51.26 per share. But as for now, we're sitting at $32 intrinsic value based on Graham's valuation. But let's go ahead and jump over to our discounted cash flow model. And in order to perform a discounted cash flow model, we need to project a growth rate to the future free cash flows for the company. So you can see right here, I've plugged in the historical free cash flow for this company so we can see the year-over-year growth rates. So we can see good year here with growth, good year here, and then a huge decline over the past year. Now moving forward, obviously, again, growth rate projections are going to be very low for this company moving forward. I'm just applying a 3% free cash flow growth rate for the future free cash flows. So I'm using that for the future free cash flows here and for the terminal value, which is the sum of all the future free cash flows past the year 2030. We then take the present value of those future free cash flows and add them together here. We add the company's cash and cash equivalents and subtract out their total debt to find their equity value. After getting the equity value, we divide by the shares outstanding, and we come to a discounted cash flow price per share of $37.64 per share. Again, a little bit higher than that current trading price. But let's go ahead and move on to our next valuation, and that is the multiples valuation model. This is a pretty important valuation model for a few different reasons. Investment bankers like to use this valuation model a lot, but essentially what it does is it values a company based on how the market is valuing companies that are similar in structure using a multiple such as the price to earnings multiple. So you can see we're taking companies like MU, TSM, QCOM, and TXN. We're taking their stock price, dividing by their earnings per share to find their price to earnings multiple. And we see that the average price to earnings multiple for companies similar to INTC is 12.93. Now, if we multiply that by the earnings per share for INTC, we come to an intrinsic value of $60.29. So that's a really strong intrinsic value. So what does that mean? Well, we can see the competitors here have an average price to earnings of 12.9. If we jump back over to our stock screener, scroll down, we can see Price to earnings for INTC is just sitting at 6.27, which for a lot of people would mean that's an indicator this company may be undervalued. But let's go ahead and look at our last valuation, and that is the dividend discount model. And for me, obviously, as a value dividend investor, I'd love to look at this valuation model because it's going to tell me what a company should be worth based on how much they're paying out in dividends and how much that dividend is increasing. We already saw they had a really nice starting dividend yield at 5%, so let's see if they have dividend growth. But essentially, what we do is we plug in the quarterly dividend payouts right here so we can see how much they pay out yearly. And this allows us to see our year-over-year dividend growth. So we have a year of 5%, 4.76, 5.3, and 5.04. That gives them an average year-over-year growth rate of right at 5.03%, so that's pretty solid. So moving forward, I am applying a growth rate of 5% for the dividends for this company. After applying a discount rate of 8.5, we come to a dividend discount model price per share of $43.80. Now again, anytime we have a good growth rate on our dividend discount model, we want to jump over to our stock screener and look at that payout ratio. We've already talked about it, payout ratio of 30.4%. So this is a very safe dividend, plenty of room to continue to grow the amount they pay out in dividends. Let's go ahead and jump over to our Outlook tab now. And here we're going to see all four of our valuation models. We have grams at 32 per share, multiples at 60.29, discounted cash flow at 37.64, and dividend discount model at 43.8. And when we average all four of these together, we come to an intrinsic value of $43.44 per share. Now the current trading price for this company is $29.24 per share. So as a value dividend investor, we do always want to apply a margin of safety. So let's say we're going to be safe for this investment. We apply a 30% margin of safety. Based off of this, our acceptable buy price for this company is $30.41 per share, meaning now may be a good time to buy this company. Now, something you do have to understand about this company is the short-term outlook is very, very bad. There's almost no growth priced into this company for the next 5 years. Even their management has made it clear that there's going to be some struggles with this company. But if you are a long-term investor and you have a long time horizon investing and you want to get into a stock that has a really high starting dividend yield, maybe this will be an option for you. I do currently own some shares in my personal portfolio, and I've added a few more shares as the price has dropped as well. But make no bad doubt about it, the short-term outlook for this company is still not looking great, and for their industry as a whole. But go ahead and put it on your watch list. Let me know what you think of this company in the comments down below if you plan on buying or selling. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.